Dividend growth investing is a popular strategy used by many investors. How does a dividend growth strategy work? And why is it important for investors? Dividend growth strategies are something investors should know about because they can be a powerful way to make passive income and build wealth over time. It's good for investors' confidence and long-term value if a firm regularly raises its dividend payments to shareholders. Welcome to our video about 3 dividend growth strategies you must know. In this video, you'll learn 3 strategies to help you get the most out of your money. Whether you're an experienced investor or just starting out, these strategies will give you the tools you need to build a strong and stable income stream. We'll discuss the pros and cons of high dividend income with low growth, high growth with low dividend income, and a balanced approach to growth and dividend income. So sit back, relax, and get ready to learn about the best strategies to grow your wealth through dividends. Let's get started. Strategy 1. High dividend income, low growth. This strategy focuses on dividend-paying stocks with higher yields. Typically, this is 5% or more. Therefore, management can enhance the dividend rate per share of the company. However, historical dividend growth has been relatively minimal. It's likely between 1% and 3%. Furthermore, the possibility of a faster dividend increase in the future is restricted. What are the stocks appropriate for dividend investment strategy number 1? Firstly, they often operate in established businesses that generate a lot of cash flow. Additionally, future company expansion opportunities are restricted. As a result, they have a limited number of internal investment alternatives with substantial returns. Thus, management distributes a significant amount of its profits and cash flow to investors, and they do so via cash dividends. Consequently, stocks with greater dividend payment ratios outperform those with lower ones. A higher payout ratio means that the company gives its shareholders a bigger share of its profits and cash flow, as much as 80 to 90% of the time. In this situation, master limited partnerships and real estate investment trusts often do well for investors. However, here's an example from a different business. A great example of strategy number 1, high dividend income with low growth in the Indian market would be a company like Bharat Petroleum Corporation Limited. BPCL is a state-owned oil and gas company that has consistently paid dividends for over 2 decades. The company has a high dividend yield of around 7% and has been paying dividends consistently for over 20 years, making it a reliable source of income for investors. In recent years, however, the company's growth prospects have been low due to the instability of the oil and gas industry and the rise of competition from the private sector. Despite this, the company's strong dividend payouts make it an attractive option for investors looking for a steady income stream. Like everything else, choosing one path over another has pros and cons. So let's talk about the pros and cons of this particular strategy for investing in dividends. Pros: you get a lot of money from dividends, you invest in businesses that have already been successful, and you don't rely much on stock prices increasing. Cons: the chances of dividend cuts are higher. The growth of dividends may need to catch up with inflation, and there's more tax to pay on dividend income. This dividend stock strategy is suitable for anyone who wants to get the most out of their dividends, so they need that money to pay their monthly bills without settling shares. Strategy number 2, low dividend income and high growth. This strategy for investing in dividends focuses on stocks that pay out less in dividends, usually less than 3%. On the other hand, dividend investors think these companies will quickly raise their dividend rates, for example, 7% to 10% per year and sometimes more. How does dividend investment strategy number 2 work with stocks? The companies in this strategy and their dividend stocks have some things in common with those in dividend stock strategy number 1. First, they work in fields with a lot of room for growth. They can invest their own money in many ways that could give them good returns. Management has to be very careful about how it spends money because of this. Since more dividends are paid out, the company only gives investors a small portion of its profits and cash flow as cash. This means that the business needs more money to put back into it, specifically investments that will make more money in the future and help the stock price go up. Because of this, stocks like these have lower dividend payout ratios. This means that the company's leaders have decided to give shareholders a smaller share of its profits and cash flow, sometimes as little as 20 to 30%. One example of a company that follows the strategy of high growth with low dividend income and yield in India is Reliance Industries Limited. The company is considered one of the largest and most profitable conglomerates in India and is involved in oil and gas, retail, and telecommunications businesses. While Reliance Industries Limited has not paid significant dividends to its shareholders, it has achieved strong growth in its business, with revenue increasing year on year. The company has invested heavily in its retail and telecommunications businesses to drive future growth. It has been focusing on expanding its market share in these sectors rather than paying dividends to shareholders. Additionally, the company has been involved in several high-profile investments, including acquiring a controlling stake in Reliance Jio, India's largest telecom operator. As each of these dividend-paying stocks has its own pros and cons, so here's a look at the pros and cons of getting high dividend growth. Pros: good chance for stock prices to go up, minimizes the least amount of tax on dividends, a higher level of safety for dividends, and most dividend increases are faster than inflation. Cons: it gives out a small number of dividends. Returns on investments depend on stock prices going up, and investors may need to sell their stocks to get money. This dividend strategy works best for people who don't need dividends as their primary source of income. Also, a person with the discipline and patience to invest for the long term has been able to ride out the ups and downs of the stock market over time. Now let's discuss the last and most important dividend growth investment strategy. But before we move to the third and last strategy, make sure to hit the thumbs up icon below to like this video. Strategy number 3: balanced growth and dividend income. Our last strategy for investing in dividends is to try to find the sweet spot. Finding the right balance between dividend growth and income will help you do this. People who invest in dividends look for dividend yields between 3% and 5%. Look for companies that increase their dividend rates per share by 4% to 7% per year. Getting dividend income today is an excellent way to keep things in balance, with the chance that dividends will grow steadily in the future. What kinds of stocks work with strategy number 3 for investing in dividends? Well, dividend-paying stocks combine the best parts of our first two strategies while operating in well-established industries and making a lot of money. That still has a lot of growth potential for a business. There's still ways to invest money and make money grow from within. But each year, even after making these investments, the company's management still has the money to give investors a growing stream of dividends. Because of this, the dividend payout ratios of stocks like these are good. The ratios are not too high to put the safety of dividends at risk, not too low where people hoard money for other less clear-cut reasons. So management still chooses to give shareholders a big chunk of the company's earnings and cash flow, with a payout ratio of dividends that is usually between 35% and 75%. One example of a company that follows the strategy of balanced growth and dividend income with yield in India is HDFC Bank. The bank is considered one of the largest and most profitable private sector banks in India, with a strong presence in retail and corporate banking. HDFC Bank has consistently delivered strong financial performance, with revenue and profits growing year on year. Additionally, the bank has been paying regular dividends to shareholders and has a history of raising dividend payouts over time. The bank has maintained a balance between investing in growth opportunities and returning value to shareholders through dividends. Additionally, the bank has been involved in several strategic acquisitions and partnerships which have helped to diversify its revenue streams and support long-term growth. This strategy is good except for a few small details. Dividends are now a great way to get extra money. To prevent risking future dividend hikes, it sets the stage for a dividend income stream that'll grow over time. When dividend increases from one year are added to increases from the years before, the total dividend payment to an investor goes up. One problem could be that few stocks meet these requirements. They also like to focus on a small number of things. Over time, it's easy to see which stocks have a high or low dividend yield. It's hard to find stocks with a good dividend yield that could grow in the future. The best time to buy these stocks is when the market is down and the dividend yield has gone up without stopping future dividend growth. It's a great idea to buy stocks at a discount, but it takes work to make it happen. On the other hand, this is how the best investors do well. It is a sound strategy for investing in the stock market, collecting dividend income and realizing capital gains. Earning satisfactory profits, however, depends on more than the share price increase. However, like with any stock market investment, it is essential to maintain a 5-year investing horizon at all times. Thanks for watching our video on the top 3 dividend growth investing strategies. We hope you found helpful information on high dividend income, low growth, high growth, low dividend income, and balanced growth and dividend income. Remember, investing in dividends can be a great way to generate passive income and grow your wealth over time. As always, it's important to do your own research and invest in a way that aligns with your financial goals and risk tolerance. Do you have any future plans for investment in the dividends? Do you still have any queries about dividend growth investment? Tell us in the comment section below because we value your feedback. Don't forget to subscribe to our channel for great investing tips and strategies. Thanks for tuning in, and we'll see you in the next video. We have also uploaded a video on the 5 best dividend stocks in India with high growth rates on our channel, which can be very helpful to you while investing in dividend funds in 2023 and beyond. You can find the link to that video in the description below and in the card.